Hello and welcome. Every year, the market follows a hidden pattern that all traders swear by. All traders, no single exception. But does it actually work? I backtested it in Python and the results shocked me. I couldn't sleep for the past couple of days. So what is it all about? One of the most famous seasonal strategies is called sell in May and go away. The idea is simple. Historically, stocks perform poorly from May to October, so traders sell in May and only invest from November to April. But is this really true or just another trading myth? To test this, let's pull a notebook and import a couple of libraries. So Y Finance to get some prices, so stock price data or rather index price data, for instance the S&P 500. Then pandas for some data handling, and also matplotlib to do some fancy visualizations. So first of all, we're going to pull prices for the S&P 500. So the ticker for the S&P 500 is caret and then GSPC. So passing that to the download function here, and then we're just starting in 2000. You can analyze whatever time horizon you're interested in. I'm just going back 25 years. So we only need the closed column here for our analysis. So I'm just filtering for only the closed column. With that, you're getting daily S&P 500 index prices. So in 2000 or in the beginning of 2000, the S&P was at 1.4K and today it's at 6K. So could have been a decent idea to just buy here and hold it here. But anyhow, that is not what this video is about. We want to test the November to April versus May to October myth, or the sell in May and go away strategy. To do that, you can make it very complicated or you can keep things simple. And to keep things simple, you have to think about what exactly you want to take a look at. So when you take a look at the strategy, just in terms of returns, you have to take a look at the past 6 returns going from April and the past 6 returns going from October, and that over all those years here. So 2000 until 2025. So how can you do that? You just calculate rolling 6-month returns for all of the month. And then you can just filter by the month and you get the past 6 returns for April to get November to April and for October to get May to October. So let's do that. So first of all, monthly returns. Just calling that MTL return. You can also call that monthly return 6 to make it more clear that this is a past 6-month return. And that is super straightforward. You just resample the data frame to monthly, and then you pull the last price. So with that, you're just getting the last price of the month, and on that you can calculate a percentage change and pass a window of 6. So with that, you're simply getting the 6-month returns in every single row here. So how can you read that? So obviously the first rows will be empty because there simply is no prior month to that. So you can just drop them off and do an in place true. And with that, you're just starting in July. So how can you read that? So 2.6% going from this date 6 months back. So this is the past 6-month return. So 2% over the past 6 months. And with that, you can super easily calculate the May to October return and also the November to April return. And how? You just filter this data frame for, as I just said, the October month and the April month. So simple as that. You just assign May Oct to monthly return and then monthly return filtered for the index month 10. So with that, you're just getting, for instance, this one, and you know that this is the 6-month return from May to October. Simple as that. Then don't be as stupid as me and actually type it the right way, and then you will get a data frame like this. So with that, you have all the past 6 month returns for the October, which is just the return from May to October. As simple as that. Same logic for November to April. Then you just do the same story here and filter for the April 6 month return. If you don't want to go this simplified way here, you can also go with the following way. You pull the monthly returns without calculating the 6 month return, and then you calculate cumulative returns from the first month on. This is slightly more complicated, but you can also go the way if that feels more intuitive to you. The result will be the exact same. Now we have the May to October and the November to April returns. And what we could do now is simply take a look at the mean returns. So is that mean return larger or smaller to that mean return? And if you think this is all a myth, so you think, yeah, there is no difference, they should have the same average return. So let's take a look at that by pulling the mean. So we have a May to October mean return of 1.6%. That's already interesting. Now let's take a look at the November to April return. 5.2%. So 3 times roughly the return from May to October on average over the last 25 years. So let's take a look at going even further back. So S&P data, as far as I know, goes back until 1917 or even prior to that. Look at that, 100, now 6K. Anyhow, that's a different story, but now we got 55 years here. So let's execute everything again. And now take a look at the mean return, May to October. We got 1.8, and November to April, we got 7.2%. By the way, these results are also in alignment with what academics and institutional research has found. So we can already say, and that's the quite interesting observation on this one, there is a difference between the May to October returns and the November to April returns. So if you want to check the, let's say, the most recent time horizon, so 2020. By the way, you don't have to pull the prices here from the API all the time. You can also just filter for the whatever you're interested in here, like DF and then DFER equals or whatsoever, right? So this is just bad practice from my end here, just a side note. So from 2020, we have an average return May to October of 6%. That's quite a return. Let's take a look at the November to April. Wow, still 11.3%. So these results are, of course, already super interesting because you cannot really say that there is no difference between those time frames. Even over the long term, not over the short term. So something about this statement is or appears to be true. Now let's take a look at not only America, but the good old Chinese people. So the Hang Seng here, or Hong Kong people rather, sorry for that. So we have the Hang Seng here. So let's actually extend the time horizon also to 2000s. So Hang Seng, super interesting for Hang Seng, I think, is that the index is pretty much the same as it was in 2000. There was a big burst in 2000, if you can remember that, which the index suffered a long time from. But anyhow, that's a different story. So same story. What do we have in May to October? We got like 0% return. And from November to April, 4.4%. So even more pronounced effect for the Hong Kong index, the Hang Seng. Now let's do my home country index. I bet you couldn't have guessed that because of my accent-free English here. So the DAX. So 2000 it was at around 7k and now it's at 21k. Good times for German investors and also all people around the world who still believe in German engineering and German whatever the Germans do for a living. So you see a negative return even on May to October and a positive return on November to April. So in Germany even more pronounced. So the people seem to really believe in that statement, or it's very pronounced in the German market, which are I think super interesting results for now. So play that for your index. I mean, I have people from all around the world. Play it for FTSE, for the UK. British people play it for the CAC Loran 40 for French people, and so on and so forth. I know you know your index. Or the Indian people, also a lot of people following from there. The Nifty, the BSE or Sensex, sorry, whatever it's called, and play it through there. Do you also recognize it? And let me know what you found here. So last but not least, I think also an interesting one is to build kind of a trading strategy around it. So the trading strategy would be stay out in this time horizon, so May to October, and stay in this time horizon. So just as a side note, and I will also do that at the end, you cannot really compare it if you directly compare it, because in the one strategy you stay out for 6 months, but you could use this capital to invest in corporate bonds, to invest in treasury bonds. So you cannot really compare it with the raw results, but at least let's get an indication of how the strategy is performing. So how can we do that with daily data? So in a nutshell, what I'm going to do, just that you understand the next steps from a conceptual perspective. So you just go over the daily returns, you accumulate them to calculate the buy and hold return, and on the same, at the same time, you just check, is that in month X, and if it is, add it to the cumulative returns, and if it isn't, don't add it. So that's super straightforward. So first of all, the returns are easily calculated by just taking the percentage change. So that will give you the daily returns of the S&P 500. So was dropping from this to this day by 2%. Quite an awful day on that one, to be honest. So then you drop off the first value because it's simply not existent, and then you do what I just said. So you want to have a Boolean mask, which is telling you if that month is in, May, June, July, August, September, October. So you just create a Boolean mask here. So I'm just calling that position bool. And then I want to be in a position if my month, so the month of the date, so this one here, is in the investment month here, right? So 11, 12, 1, 2, 3, 4. So November to April as discussed. You can also do it the other way around and then work with a tilde here, just as a side note. But this will give you a Boolean mask for whenever that is in November to April. Somewhere I messed up with the parentheses there. Don't know why I put that in here in the first place. So this will just give you a Boolean mask. And you see it starts with a true value because this is in January, and the January is part of the month where you are supposed to invest. All right, so you just apply that Boolean mask on the returns. So you just multiply this array. So true value is 1, false value is 0. So you just can multiply this array with the returns, and then you will get the strategy returns. So how do you do it? You just take the f log or rows, and then you give the row a name, strategy return, and that is simply the Boolean mask, as I said, times the daily returns. So when this falls, you will be in May to October, and then you won't get any returns, so you stay out of the market, and in these months you're in the market. All right, so this is how it works, super straightforward. And then to compare the returns, so this is how the data frame looks like now, and what you just need to do now is to accumulate the returns. So you accumulate those returns to get the buy and hold returns, and you get the you have to accumulate the strategy returns to get the strategy return for staying in the market in those juicy months here. So how can you do that? You filter the data frame for returns and the strategy return, and then you have to add a 1, mathematically do it to accumulate the returns, because you want to calculate the cumulative products out of these two. And with that, you have the buy and hold return. So this, how can you read that? The strategy 3.2x your capital, not the strategy, sorry, the buy and hold approach 3.x 2x your capital, and the strategy return 5x your capital, which is a clear result here. So remember, we are still in the DAX, so I mean, you might be interested in the S&P 500 rather. So let's get rid of that, do all this stuff again, do all this stuff again. So we have it for the S&P 500, do this stuff again, this stuff. And here you see the buy and hold is actually outperforming the strategy return. So you 4x your capital, and here you 3x your capital. So everyone likes visualization to see it better, so you can just plot, and then you see the S&P 500 return, the blue line here, versus the staying in from November to April return here, right? Which is a very interesting chart in my opinion, because you see that this strategy is actually, at least in the vast majority of the time period, outperforming the buy and hold approach, except this last period here. But, and that's what I already said, you see those flat periods here, right? This is just the period where you stay out the market. I think I'm limiting the time horizon, then it's more clear what you see here. So let's just go back 5 years here, pull all the stuff again. And then, yeah, this is a nice chart. So you see here the S&P 500 return, or cumulative return, and then you see the strategy return here, right? So here you stay out the market. So here you are in this sell in May and go away, and then come back, and then again and again and again. And what I'm just saying is, in these periods, you can not only hold your cash, but you could invest it in another asset. So in a bond, in a treasury bill or whatsoever. And you could accumulate further returns here. So you cannot really compare those charts, but they give you a good indication of this strategy. And the picture is a similar picture to the mean return, that this is definitely something to take a look at. Now, we saw that the strategy even outperformed the buy and hold for the German stocks. Let's quickly pull it for the Hang Seng, and then you can do your own analysis and let me know what your country is doing here. I'm always interested in other markets. So interestingly, for the Hang Seng, so for the Chinese market, you see this crazy overperformance of the strategy return, right? While the Hang Seng, at least over the last 5 years, was constantly losing, this strategy would have made you some bucks here, you see, and that is a very interesting one, without taking the compounding effect or the other asset effects of these periods into account here, right? So we could even go further back here to 2000. Yeah, and even over this period, the strategy would outperform. Finally, last but not least, good old German people, you would get an outperformance, interestingly. So I hope you found this overall as interesting as I found this. Let me know your results, your thoughts below. I'm happy to do other tests of those, myth. I'm looking forward to that. So for instance, yeah and rally is also a concept you could analyze, and many, many more topics like that. So if you like that, let me know. And I thank you very much for watching and looking forward to see you in the upcoming videos. Cheers. Bye. Bye.